Let's look at some financial planning model. How do we do this financial planning? Basically, we need a growth rate. And to a large degree, it helps if you know what the president, CEO, CFO, the C-suite is thinking, what kind of growth they want in the company. At Air Products, it was 15%. That was kind of a minimum that our executives wanted from us. If you came in with 10%, you usually got bumped back down the steps and said, try again and rework your numbers, sharpen your pencils, they would say. And here's an example of a company named Rosengarten. They wanted to grow 25%, so a pretty aggressive sales forecast. They're going to look at their cost as a percentage of sales. So we're going to use a percent of sales approach all the way down to net income. And we would calculate their net income as a percent of sales, or profit margin, or net return on sales as 13.2%. That's what it was in year one actual, and that's what it will be in the forecast. So you can see we set up two columns here to do the first year. We look at last year's actuals, and then we project out 1 year in the forecast. So what's going to happen next year? Sales will be up 25%, cost will be up 25%, all the way down to net income, all the way down to dividends, additions to retained earnings. In reality, a big company like Air Products or IBM or Meta, for instance, Google, would have a gigantic income statement. It might be 20, 30, 40, 50 lines long in detail. Each line item would have a different assumption. But for sake of simplicity, we just say each of these line items is going to grow 25%. We could also take a percent of sales approach and say what our cost as a percent of sales last year, actuality, what was our performance, 83.3%, and I could apply that 83.3% to our new sales number of 1250 to get 1041. So there are many ways of calculating these numbers. Taxable income, I can even calculate in addition to the factor up method of taking last year's taxable income times 1.25. I can also just use subtraction, sales minus cost, to get taxable income. So there are many ways to do these numbers. I can also do percent of sales approach. 167 over 1,000, 16.7% times 1250 will also get me to the 209 figure. Taxes are 21%. Corporate tax rate under the new Tax Cuts and Jobs Act of 2017. And so we could forecast our taxes three ways. We could take percent of sales, we could take factor up approach, or we could just use percent of taxable income, 21% of 209. Gives us our 44, and then net income we can do by subtraction. We could use percent of sales approach, and we can also use factor up approach, 132 times 1.25. So if you're totally lost, just take column A, actual, times 1 plus the growth rate, 1.25, to get column B, forecast. Should we pay a dividend? Well, we paid dividends last year in actuality. What percent of that net income pie of 132 did we pay? Well, I can see we paid 44 over 132. That's 1/3. And that means we kept 66% or 88. We kept 2/3, gave away 1/3. And we'll do the same thing on that $165 million this year, if these were in dollar millions. So in that case, I would, of my net income pie of 165, I would give out 55 and I would keep 110. Back to Rosengarten, I can do that. Dividends are 1/3 of net income. Additions to retained earnings are 2/3 of net income, and I just take 1/3 of 165 and 2/3 of 165 to get those numbers. Like I said, I can also do percent of sales approach. You can see that in actual year one, I gave away 4.4% of my sales, or and I kept 8.8%. I can apply those percentages times the new sales number of 1250. So three different ways at least to calculate these numbers. Like I was saying, if you're totally lost, just take column A and multiply by 1 plus the growth rate. Circle that. Notice that 110 addition to retained earnings, our accounting friends will take that at the end of the year and throw that into the retained earnings account on the balance sheet. There's nothing you can do about that as a financial analyst, or the accountants are required to do that as part of generally accepted accounting principles. So they will take that addition to retained earnings, circle it, move it over to the balance sheet. And remember that 110 number for a few minutes. So my dividend payout ratio in year one and year two was 1/3, and my retention ratio was 2/3. So of that net income pie, I gave away 1/3, and I kept 2/3, both in actual and in forecast. Some items vary with sales. Again, if you have a multi-line item income statement and multi-line item balance sheets. Some of those items will vary directly with sales and others will not. Some do not. In this example, long-term debt and equity did not vary with sales. I think only accounts payable in the Rosengarten example in the book varied with sales. So basically on the balance sheet, this one's unbalanced. I did the same thing. I took my actual numbers. You can see I multiplied all of them by 1.25. So that's how I get the forecast column. My assets of 3,000 grew to 3,750. And that's simply 3,000 times 1.25, as I said earlier. On this example, only accounts payable vary with sales. So I take 300 times 1.25 to get 375. But notes payable, long-term debt, common stock, or retained earnings, they all get nah. They don't increase at all with sales. Only the accounts payable vary with sales. So all those other ones we leave the same. So the accounts payable go up 25%. All those other numbers you can see are the same. Our retained earnings being the simple exception. But remember, I did add that 110 coming over from the income statement from the additions to retained earnings account. So I must put that 110 in there. And then I ask myself, I look at my balance sheet and say, am I balanced? Am I balanced here? I have 3,750 on the left. I have 3,185 on the right. Am I balanced? And the answer is no. And recalling my accounting teacher who said, it's got to be balanced. I can't go home from work till that balance sheet is balanced. And my colleague Fred used to always say, Fred, what do I do? I'd ask Fred, what do I do when my balance sheet's not balanced? He'd say, plug it in. So basically, I'd have to plug it in and figure out the plug, and that plug is 565. It's simply 3,750 on the left minus 3,185 on the right, and that is external financing needed. I have to go out and get either debt and or equity and plug that into the balance sheet next year if I want to grow at 25%. That's the moral and end of the story. I can plug it in and I can allocate it so that this balance sheet is balanced. Notice that the author plugged in 225 of that 565 into notes payable and 340 into long-term debt. Now, the one thing you can put those numbers anywhere. You could put the whole 565 into notes payable if you want to. What you have to watch out for is you have to be very careful of your ratios, current ratio. Did you destroy your current ratio if you put all of that into notes payable? Or you could put the whole 565 into long-term debt. Did you just destroy your long-term debt to equity ratio? So ratios are very important when doing this strategic planning. And you have to hope and pray that when you do this growing that you don't destroy your financial ratios that might have been solid in the year before. We can move on because the balance sheet is now balanced. We can leave work.